So far, we have been talking about how to calculate different ratios and how to interpret those ratios. But equally important, we need to understand the impacts of business decision on these ratios. One day when we run the company, when we become a CFO or CEO, we make a lot of decisions, and we need to understand what's the consequences of our decisions, not only on our operational results, but also on the financial ratios, because people outside the organization, they are looking at the financial ratios for various reasons. So let's talk about impact on liquidity using some of the examples. Because we understand the liquidity measures are typically working capitals, current ratios, and quick ratios. In their formula, there is a couple of variables like current assets, current liabilities, as well as quick assets. So basically, any decisions that result in a change in the values of these variables can cause these ratios to change. For a financial professional, one needs to understand and communicate the potential impact of a business decision on these measures. If you work for the organization, or you need to understand the potential causes of the observed changes in this ratio if you're the one outside the organization and you are examining the organization's financial statement. For example, if repaying a short-term debt using cash, so how is this going to impact your working capital? How is it going to impact your current ratio? Well, you can think about if you retire a short-term debt, that means your current liability is reduced, but so is your current assets because your cash is reduced with the equal amount. So in this case, there is no impact on the working capital, right? But how does that impact your current ratio? Well, for those of you who are still are pretty good in math, you understand you can't answer this question straight without a qualification. Why? Is because the current ratio will be impacted, but on which direction is going to increase the current ratio or decrease the current ratio? Well, that depends on your current existing current ratio. Is it greater than 1 or less than 1? If it is greater than 1, then which direction of your current ratio is going to move when you're using cash to retire short-term debt? That means your numerator is going to be reduced, so is your denominator, but they reduce the same amount. If it is greater than 1, the existing one before the change is greater than 1, when you reduce the numerator and your denominator with the same amount, if the existing is greater than 1, that means your change is going to move this current ratio to higher or lower. Think about this. It's going to be moved to lower because your numerator change proportionally is less than the denominator change right now, because you're thinking since it's greater than 1, so before the change your numerator has a higher value than the denominator. So numerator is greater than the denominator. If you reduce the larger number with the same amount, then with the reduction in your lesser amount, so the impact to the lesser amount is more significant. So when the numerator is reduced proportionally less than the denominator, then the value of the fraction is going to go up. Did I say go up or go down earlier? Let's take using an example here. You can see what just demonstrate. For those of you good in math, you already understand what I'm talking about. Just like you're going to see here. Let's see. We're going to use a pen. So if the existing one is 3 to 1 or 3 to 2, all right, the current ratio. When we reduce 3 and 2 each by 1, so that becomes 2 to 1. Obviously, this one, the value here is greater than value here, so it's causing this current ratio to go up. But if it's opposite, if let's say if this is like 2 to 3, so the existing current ratio is less than 1, then when you reduce the numerator and denominator by the same amount, both reduced by 1, then this ratio, it goes down. All right, so that's for that one. Another example is, let me ask you another question. If you're acquiring inventory, so at the end of the year, you want to take advantage of the supplier's clearance sales. The supplier says, if you buy some inventory right now at the end of the year, we'll give you some discount. So if you're using the inventory, acquiring inventory using cash, so how's that going to do with your working capital? No change, because again, your current assets, the total amount of current assets is the same, and total liability did not change, so working capital does not change. But if you're using the short-term finance to buy your inventory, it means you use accounts payable, how is that going to change? Think about it. So in this case, your current assets goes up because you bought more inventory, but so is your current liability because it goes up by the accounts payable. So again, it does not change your working capital. All right. What about current ratio? So if you're using cash, then there's no change because total assets does not change. Total current assets does not change. Neither the current liability, right? Because you're using cash, you just change one form of assets to another form. Instead of $1,000 cash, right now you have $1,000 cash less, but you $1,000 inventory higher in the value. So there's no change in current ratios. But if you're using current short-term debt to finance purchase of inventory, now we're talking because accounts payable goes up, so is assets. But how's the current ratio? Well, that goes back again. Is it greater than 1 or less than 1? That will determine which side of direction the change will cause in the current ratio to go. What about quick ratio? If you're using cash, does it going to change your current ratio? No, your quick ratio? Yes, it does. Goes up or goes down. Well, it'll cause your quick ratio to go down because your cash is reduced. Your quick assets is reduced because quick assets, remember, does not include the inventories. So when you're using the cash, the quick assets to buy a non-quick assets, that means your quick assets value goes down. So your quick ratio goes down. What if you use accounts payable? Well, if you use accounts payable, again, the quick assets value is quick assets ratios go down because your quick assets does not change, but your liability goes up. Your current liability goes up. So that causes the ratio to go down. Another question, if you're acquiring long-term assets using cash, how is that going to change your liquidity? Obviously, intuitively, it's going to reduce your liquidity because now you have a liquid assets, which was cash, but you convert it to a illiquid assets, which is a long-term assets. So in that case, then your liquidity, all the liquidity measures go down. But what if you use long-term debt? If you use long-term debt to finance your purchasing of long-term assets, then it does not impact your liquidity because the liquidity measure is how liquid your current assets is against your current liability. If you use long-term debt to finance your long-term acquisition, then neither current assets nor current liability had any changes to it. All right. So this particular question says the Star company has current assets of 400,000 and the current liability 300,000. If you Star could increase its net working capital by what? If you want to increase your net working capital, what do you do? Well, in this case, you should refinancing your short-term debt with long-term debt, because once you reduce your short-term debt, then your working capital is increased. You increase long-term debt, that has no impact on your working capital. All right, so that's what you should do. The other three, they're not going to increase your working capital. What about this one? Year one, company cash is 15% of sales, and then the accounts receivable 10% of sales, inventory is 20% of sales, accounts payable 30% of sales, long-term debt is 5%. So the company is preparing its forecast and anticipated sales will increase from 50 to 55. So your sales is going up by 10%. The company uses percentage of sale methods. What type of how much amount of net working capital you should have in order to support this 10% increase in sales? Well, you can look at this way. So if your net working capital reports directly, so basically you're saying that the company net working capital is 15% of sales. So 15% of sales, and 10% is your accounts receivable, and 20% of sales is inventory. So your anticipated sales is 55%. That means you will say 15% cash out of 55,000. All right, that's your cash, so on and so forth. And the 10% of 55 is your accounts receivable, and 20% of inventory is your inventory, but 30% is your current liability. So basically, you have 15, 10, 20, but minus, that's your current assets. So your current assets is like 15 to 20, 45% of your sales, while your liability is 30% of your sales. So basically, your net working capital is 15% of your sales. So in this case, your year two is 55,000. So 15% of 55,000 is 8250. So the correct answer here is D. Let's talk about impact on activity and return ratios. Well, we know the activity ratio. Some of the typical activity ratios we operational assets usage efficiency, for example, like inventory turnover, accounts receivable turnover, accounts payable turnover, and the other type of efficiency measure is even investment assets usage efficiency. One of the example is assets turnover. For the return ratio, typically we have three measures: ROI, ROA, and ROE. Okay, so let's look at an example. Let's say you want to take advantage of a year-end incentive, like earlier we said, by your supplier. So you want to acquire a significant amount of inventory, preparing for the next year, and you want to use cash or accounts payable, either way. Well, how is this going to impact your inventory turnover? Well, so if we purchase more inventory before the end of the year without impact this year's sales, that means the cost of goods sold of the current year won't change, but your average inventory of the year is going to be changed. It's going to be increased because you have all the inventory sitting in the warehouse. So your total inventory of the year, average inventory level is higher. In this case, then your based on the formula, your inventory turnover ratio is going to go down because your denominator has a higher value at this time, right? What about if we use credit to make this inventory purchase? In that case, then your accounts payable is going to be impacted because you will incur more accounts payable. What direction does it going to go? Well, it depends on the current existing accounts payable ratio is greater than 1 or less than 1. Typically, it's greater than 1. So if that's the case, then if it's greater than 1, then we'll again your accounts payable, the formula is total purchase on credit, so the numerator is go up, but so is your accounts payable. The denominator also go up. So that's which direction does it goes depends on, again, whether it's greater than 1, your beginning point is greater than 1 or less than 1. Okay. The second question example here is, if you want to replacing the existing equipment and sold it for less than its current net book value, with more technologically advanced and more energy efficient new equipment at the end of the fiscal year, how is that going to impact your return ratios, ROA and ROE? Well, think about this. ROA is calculated as earnings divided by assets. ROE is earning divided by equity. If you kind of visualize the balance sheets, replacing an existing equipment and sold it, the old equipment is sold with less than net book value, that means you're going to take a loss. Assuming that you have financial accounting, you know how to do the book control. Here, basically, you're going to debit cash for whatever the value you sold, and credit the PPE for the book value, and then the difference between the book value and your cash received is going to be debited as a loss. Okay, which is going to be against your current year's income. So the results is going to be your current year income is going to be reduced because of this decision. All right. If the income is reduced, then obviously the ROI or ROE or ROI, the R is reduced. So how about the value of the ROA and ROE? Well, for sure, for E is also going to be reduced because your earning is less. But which direction does it go? Again, it depends on your ROE is greater than 1 or less than 1. Most likely, the ROE, the existing ROE is less than 1. So in this case, proportionally, the reduction in the equity is less than the reduction in the earnings. So ROE will be reduced in this case, all right? But for the ROA, for sure, because your new value, the value of the new machine is going to be higher than the value you gave up on the new machine, on the old machine. So your assets goes up while your earnings goes down. So the value of ROA is going to go down. If you use the debt to make purchase of the new machine instead of cash, then your assets goes up even more so than when you're using cash. Okay, so that your ROE will even go, your ROA will go down even further than you would when you use cash to make the purchase of new equipment. But for the long term, however, this decision may result in significant improvement in a company's overall ROA and ROE because of improved earnings from the more advanced equipment. All right. So it's a good. It's still long-term good, but that gives. So for people from outside looking in, you probably don't want to just simply penalize a company because their ROE and ROA is reduced. You need to look behind the decision that causing the ROA or ROE is reduced. Is it because they really did not do a very good job, so their earning went down, or is because the decision, like I just replacing the existing, they made some long-term investment for their long-term gains and by sacrificing short-term earnings. So you need to differentiate that. Lastly, for the assets turnover, in this case, in this particular situation, is definitely well reduced because the current year's ratio, due to the increasing value of the assets. So your assets turnover is go down. Again, short-term sacrifice for long-term gains in this case. Let's look at this example. Each of the following will affect company's return on investment, except, well, the correct answer is B. So A, C, D, they all will reduce, will impact company's return on investment, except B, because B is if you maintain the company's current cost of capital at current level, that means your cost of capital stays the same, your investment amount stays the same. So that has no impact on your decision, maintained status quo. This one, two companies have identical return on assets. Company X purchased most of its assets many years ago when price was relatively low. Company Y purchased most of the assets in recent years when price is relatively high. Both companies are identical debt level and record their assets at a historical cost. So the return on assets ratio is most likely, in this case, is definitely company X will have higher, while everything else equal, the company X will have higher return on assets because assets is valued at a historically low price, while the company Y made the most recent purchase, so their value of the assets is higher based on the historical ones. All right. So the overstated company X, our A is artificially kind of overstated, but doesn't mean they're better. They are a better performer in terms of ROA than the company Y. So again, you can't just purely look at the value. You have to look at the background. All right, you can't. Generally speaking, we prefer higher ROA than lower one, but in this case, higher doesn't necessarily mean better. So this question: company's year 4 gross margin remained unchanged from year 3. However, the company year 4 net profit margin increased from year 3. Which one of the following could explain the change? So your gross profit means your revenue minus cost of goods sold. That's what it is. Does not change. So it means the difference between your sales price and the purchase cost of your inventory is the same. The difference stays the same. But your net profits go up. That means your operating expenses are less than what before. Okay, so in this case, the ABCD only item that refers to operating expenses is the corporate income tax rate decreased, because preferred dividend, that's the transaction between the company and its an investor. That's not an operating transaction. Cost of goods sold decreased relatively to sales. If cost of goods sold decreased, that could cause the gross margin increase. But we say the gross margin stays the same. So D is not correct. Sales decrease at a lower rate than operating expenses. That will cause the entire net income to go down, which in this case is not the case. So the B is the answer for this question. This one is many measure performance are based on accounting information. For example, you can evaluate return on investment according to the basis for stating this measure is dollar. Assuming ROI is the chosen measure, the investment is defined as total assets. Comparability problem are most likely when the attribute used to calculate total assets. Well, this is similar to the earlier one. Or which one? Just different way of asking it. So this one is basically test you on the same concept. Here the correct answer is C, because when we use historical cost, then it's very difficult to make a comparable comparison to compare, like here. Okay, although the ROA of company X is better than company Y, but you can't say the company X is better than company Y when it comes to using its assets, because they use the historical cost and they bought the assets at different time. So The correct answer here is C. All right. For this particular, there's 4 segments. They want to ask what's the net income as a percentage of sales. Basically, we don't have a net income number here, but we can, if you understand the minimum ROI, which is residual minimum ROI is 6% for segment B. So what's the minimum rate earnings? Well, ROI is calculated based on the earning divided by investment. So earning divided by investment equals 6%. That means earning is how much? That means, so 6%. So you can calculate. So that's earning is $30,000. All right. So $30,000 is our earning, and then we divided this by the sales, which is 750. That gave you 4%. So the correct answer is 4%. But this question also can ask you about segment A, segment C, segment D with different things. But they mentioned the residual income again. This is residual income is equal. Go visit the formula, then you can figure out how to calculate residual income. We have this one, then we have ROI, you have the investment. So they can also ask you for segment C, what is the net income percent as a percentage of sales. Basically, for each of the C, A, B, C, D, there's a way you can calculate what the net income is. Like for B and C, I'm sorry. And this one is already given to you. So there might be some other way to ask questions about segment A and segment D. All right, thank you. To put everything together right now for this particular segment, I just want to emphasize, again, know how to calculate the ratios, note how to interpret in the ratios once you had the calculation, but equally important, if it's not more important, is understand how business decisions is going to be impact. What are the impacts of the various different type of business decisions on these ratios? Not only from inside the financial professionals working for the organization perspective, but also is very important for the financial professionals who work outside the organizations. All right, thank you.